My biggest weakness in the past was I was too bearish. I almost structure most of my clients with two different portfolios. One where you're targeted to kind of beat the S&P or do similarly, and another where with less risk. If you have 100,000 allocated to Bitcoin and it grows to $1 million, just keep it forever. Because to me, it's a forever kind of asset. The only way to transmit your values is through, this could be a whole future show, is through legacy planning. I would consult with Bitcoin millionaires, newly minted million. Okay, they go from 0 to 40 million. Take 2 million off the table. Take 5 million off the table. I am probably more of a Bitcoin maxi than they are. I get Bitcoin. It makes sense for me as the digital gold. I don't believe in all these other, altcoins, shitcoins, cryptocurrencies. They may have utility and they have value. I don't even understand it. That's not my world.
Hey everyone, thanks for watching this episode. If you enjoyed this episode, make sure you like and comment below. And to find future episodes in your feed and push notifications, make sure you subscribe. And if you click the little bell, you'll get every new episode as it's released. Thanks again for watching. Today, I'm sitting down with Josh Jalinski. Josh is the financial quarterback. He is the CEO of Jalinski Advisory Group, Inc. and Wealth Quarterback LLC, which is an SEC-registered investment advisory firm that provides fiduciary fee-based planning. Josh manages investments for his clients by focusing on asset protection, income generation, and tax mitigation strategies. In addition, Josh also hosts the talk radio show called none other than The Financial Quarterback, which is on WOR 710 AM in New York City and iHeartRadio and Spotify internationally. Josh has been named to the top 100 financial security professionals in the country for the last 2 years in a row by Forbes. And Josh has appeared on CNBC, Fox Business, CBS, Bloomberg, Cheddar, and other media outlets as a financial expert. So without further ado, let's dive in with Josh Jalinski. Hey guys, I'm going to take a quick pause to introduce the first sponsor on the Jay Gould Show. I am happy and proud to say that this show is now sponsored by Withum, Smith & Brown, which is a forward-thinking, technology-driven advisory and accounting firm that is committed to helping big and small companies be more profitable, efficient, and productive in today's complex business environment. Withum now also has a dedicated crypto and blockchain technology team to help early-stage businesses properly navigate all the crypto tax-related matters. I've been using Withum both personally and professionally for nearly a decade for all of my business's personal needs as well. I'm very happy with them and I highly recommend Withum. You can contact Withum by visiting their website at withum.com. Now back to the show. Josh, thanks for joining.
Hey, Jay.
So for people listening today, they're not going to believe this one, but my company, Yashi, that I built and sold years ago, that I talk about a bunch, your business was right across the street on Hooper Ave in Toms River, New Jersey, and I had no idea. We saw each other on Clubhouse, and we actually grew up in the same area. We played at football against each other. Well, not actually. I'm a little bit older, but we played. The two towns were rivals: Central Regional High School and Lacey Township. What a weird coincidence, man.
And you were good friends with a guy that I grew up with 5 houses down the road. That's crazy.
Yep, Roan.
Better friends. That's
weird.
That's weird too. And we never met. Yeah. We met on Clubhouse. That's crazy.
Exactly. I tell people, like, people laugh at these social media apps, and there's a lot of value. You got to go through all the noise, right? But there's some signal.
We were literally, I think, across the street from each other. And the only reason I knew you existed, I mean, I heard of Yashi. The only reason I knew you existed was a guy, Mo LeBeau. I think that's a fake name on Clubhouse. Was a listener of my radio show and says, "You got to meet Jay." And I think we were probably too busy working. You were building Yashi and I was building my company.
I don't know about you, but like me and Jason Williams became friends on Clubhouse. And he said something that really stuck with me too, to American Hodl, who you're friends with, right? And he was saying something like, there was some reference to a movie. And he's like, I haven't watched a movie in 10 years. I was building businesses and selling them. Exactly. And that was me. I have no cultural references for like a decade.
Exactly. I got to go like catch up. People talking about Breaking Bad. I think I watched Breaking Bad for the first time this year.
Exactly. Well, it's a crazy coincidence, and I'm glad we got to meet each other and become friends. It's amazing to see another great success story out of Toms River, and there's a lot of them. So it's great to meet you as well. So I wanted to talk about your business. I want to talk about what you do because of the market we're at right now, and we're in a bear market for the first time really since 2009. I don't really count 2020; that was a kind of blip in the radar. Um, Tell us about Jalinski Advisory Group and what you guys do at the Financial Quarterback, your radio show. If you could, in your own words, describe kind of your business and how you're managing wealth for your clients.
Well, Jalinski Advisory Group focuses on income generation and asset protection, helping our wealthier clients protect their assets from the tax man, structuring estate planning, legacy. A lot of people don't even have a will or basic trusts. Emerging wealth. I mean, we know in the Bitcoin rooms, these guys don't even have a will and they have, 20 million of Bitcoin.
On a USB
Insane.
drive.
So we got wills, trusts, although I'm not an attorney, work with people's attorneys. And then Wealth Quarterback is our fee-based fiduciary planning firm. And we were one of the only Bitcoin centric firms that I know where we appreciate it as a part of the asset allocation conversation, although I don't like many other crypto currencies. And then Financial Quarterbacks, my radio show, it's been on since WOBM, which probably broadcasted your football glory at Central Regional High School. And I grew up Lacey, the town down the road.
Yep.
They were rivals. I started at WOBM when I was, 25, and then 28 was ranked one of the top 5 advisors in the country by Senior Market Advisor. And then, we built up, and now we manage, like almost 600 million for our clients.
That's amazing.
One account at a time. My first client was my mailman. And since people where we're from, they hold on to 50 grand like they've won the lottery. So it was not easy.
No, it's not easy. It's never easy coming up, right? People see it. I would say it's a 10-year overnight success story, and you're a 10 plus year overnight success story as well. So people see you now and they're like, "Wow, man, it's crazy. You got lucky." I don't know about that.
Yeah, I remember I'd go from like 2 a.m. to 6 a.m. I tell everybody your best time to build wealth is your 20s.
Yeah.
Because you could be an animal. And I'm not old now, but I had a lot more energy 10, 15 years ago. I have a lot of energy now. I can work.
Josh, you had a lot less kids 10 years
Yeah.
ago.
Yeah, there you go. I get 7 beautiful kids. But yeah, that's crazy. I was we have these recruits and they're like 20, 21. And I was working like an old school day where we would like packing in at 10 a few weeks ago. And they're like, "Dude, does he work like this all the time?" To me, that's fun. But
yeah. I saw Druckenmiller do an interview recently, and it was from the summer. I think it was done in July, and the guy was kind of stroking him a little bit and saying, a lot of people say your returns have been amazing, 30+% for decades, as you're aware of his return profile, right? And he actually said, he's like, "I'm not seeing those returns these days," because he's a little more risk averse as he's gotten older, he said. And plus, you don't have your finger on the pulse as much for certain things that are up and coming. Younger people do, he said. That was kind of an interesting point, by the way. But the guy said, he's like, "But people don't recognize that you are one of the hardest workers on Wall Street. This guy's working 7 days a week, all the time, 2:00 in the morning, sending emails, all this kind of stuff." And he's like, "I was pretty lazy. I was a C student in school. I kind of was a BC student too." He's like, "And I was kind of, I don't think of myself as a hard worker." He's like, "I just don't think this is work. I just found something that I just love." He's like, "And if you look at all the best professional athletes, whether it's Tom Brady or, Tiger Woods or any of these guys, right? Michael Jordan, they just are obsessed with what they do. And not because they're trying to be the best, they just love doing it. They love it so much that it doesn't feel like work." And I would imagine you probably echo the same thing, right?
Oh yeah, I could sit with clients. I love being with our clients. They're like family. And, I could be with somebody worth 70 million or somebody worth 70,000. It's something about just connecting with people, their heartfelt dreams, desires, values. Some of these people have never had those conversations about their money, and and we structure things for the people they love and the causes they love. So it's very, I don't know, I get a rush. I could be in meetings. I need my assistant to say, "Hey, next meeting," because I just like connecting.
Let me ask you this. when I had my business, one of the things I was really focused on was concentration risk, right? So we had a lot of websites that we managed advertising for. And so I always made sure that none of our top website would never account for, say, more than 10% of the revenue. Same on the customer side for the ad agencies. In your business, do you think about concentration risk with clients? I would imagine you wouldn't turn business away as a result. I did actually, because for a customer paying us, I was afraid they would be kind of hold our head over a barrel, kind of, and maybe renegotiate terms and screw up the business. And I've seen it happen to other advertising technology companies actually. What kind of concentration risk do you have? And you know, you have $600 million plus AUM. Your largest client, what would that account for? And then like your smallest client, what does that account for?
We did an arithmetic mean of accounts, and we found it was about 250,000, which was shocking. It's actually the same number that I think Edelman Financial had. So I think that helps us spread our risk. I don't know what percentage. I mean, our top 10% probably account for, top 20% probably account for 80% of the revenue. So
Yep.
there have been coaches who say just, ditch the other 80. But I always found it to be a very loyal group, easier to service. I think my father grew up as Al Leiter's banker, who I know you've had on your show before.
Mhm.
And I've always thought of that, like Mrs. Leiter coming into the bank. And although we don't manage their money yet, but, this was like 30, 40 years. So he saw him come up. And then one of the guys John Smallwood out in Shrewsbury, he just passed away. He always said, never turn away a client because that $50,000 account may turn into a $50 million account. And he had told me stories. So we really don't turn away business. But I do think it helps us with concentration risk. It does, if you lose, 10, $5 million accounts, that's almost 10% of the revenue, something like that. But as we've been growing, our probably average new account size for me is about 2 to 10 million of management, assets under management. But we have other guys who are younger than me and also we've younger than me, but they still have CFPs, CFAs, that they're very competent. Some of them have been like 30 plus years on Wall Street, but we'll give, some people just starting out, they were a bond trader, but they don't really know how to be a financial advisor, but they still have all their degrees, licenses, all that stuff. We may give them a $50,000 or $100,000 account, but I still like to deal with regular people.
What would you say your largest account you've managed has been? Not the person, just the dollars.
It's
Obviously.
more of the family relationship. Some of these are generally more consulting. We consulted with a $1 billion family. We consulted with 50 to 100 million, a couple families. I mean, down where we're from, there's not many. So
No.
Most of those clients were from New York City or Connecticut who listen to my radio show, or Florida. Our show broadcasts on Spotify and iHeart. So we get a lot of people who listen to WR all over the country. But no, I think probably our average now is about 2 to 10, but our arithmetic mean is 250, which is funny. And a lot of these firms too, they'll say, "Oh, our minimum account size is $1 million."
Mm-hmm.
This is a little tip for people listening who want access to good financial advice. Just go to the person and say, "Hey, I'm a go-getter. I want you to be my advisor. I'll bring you more business in the future," or something like that. Because I found that most advisors just put that on their website to appear bigger than they are.
Mm-hmm.
It's not, I don't know, like if they put, "We'll take anybody," it breeds, it loses the exclusivity.
Exactly.
Factor.
So when we sold the business, you guys didn't knock on the door, but Morgan Stanley did, Goldman Sachs, UBS, every
Should
one of them.
have, but I don't door knock. People just come.
Yeah, no, but my point is that they all reach out, right, when they see a
Yeah.
public sale, and everybody got in touch, and we sat down with them, and one of the firms, I've told you about this too. One of the firms I thought was interesting was Bessemer for trust administration and estate planning and stuff. But it was crazy. Like I didn't want them to manage any of the money. I wanted them to just do that service. That's all I wanted them to do. I'm self-directed, so I don't really want people managing it for me.
And that's what we do with a lot of our 50 million and north clients we found. That's almost a special niche because they have all their people, but nobody looks after all their affairs, kind of as
That's
like
right. And they all charged ridiculous fees. It was like a minimum, I think, of $100,000, regardless of anything. And I'm like, this just doesn't even make any sense. Like, this is more legal work than anything.
Yeah.
There's an element of financial planning, obviously, within that the lawyers cannot provide. Which is why I think firms like yours, which you say you do, I think it's great because you can bring in the legal advisory work from the estate planning aspect of it, but also understand the financial aspects of it as well. So you're not missing something. And then not charge an arm and a leg for it. Like, it's just because the reason they do the minimum 100 is they want to get some of your money. Cause it's like, you got to start, you start averaging and you're like, well, if they manage this at the fees, then I wouldn't be paying. They know what they're doing. Right. But I don't think it's appropriate. And I think what you're doing is better, that you can do that separately and allow them to continue to do what they do with their wealth management.
Yeah. We've had people manage their own money. I mean, they're CFOs of Fortune 500 companies and they just want somebody to make sure their accountant and advisors aren't screwing them. Yeah. And it's not that they're being screwed. It's that they'll go to somebody. We live in New York, New Jersey. Well, a New Jersey-based attorney, even if they're the best trust attorney in the state, is not going to refer you to a Nevada attorney to do a Nevada Dynasty Trust or a South Dakota Dynasty Trust. And most financial advisors are not cognizant of how to structure even a Bitcoin trust. There are places you want to do it in. You don't want to do it in probably New York or New Jersey. That's right. So they build their wealth. And because we're true fiduciaries, we might say, do this here, or even like life insurance to pay estate taxes. A lot of the times those policies aren't structured right. They need what are called ILIT audits, irrevocable life insurance trust audits. So there's a whole new space that we're sort of carving out away from the legacy firms, although it's hard because, most of the big money's with the legacy firms. But, we're cracking at it one client at a time.
Let's dive into performance now. So I know that it's hard to really talk about this, but like on average, when you are managing wealth for somebody, what kind of return profile have you, and you've been in a great market for the last 13 years, right? But what kind of return profile have you had relative as a benchmark to say the S&P or the NASDAQ? What was your average return for your clients managing?
We can, due to regulatory disclosures, the SEC has come down on many RIAs for projecting things, but we have about a 99% satisfaction rate for our clients. So most of them are very happy. I will tell you that the concept of S&P NASDAQ kind of as a benchmark, a lot of our clients tend to be older. So that really isn't the benchmark we use. A lot of people don't really. I remember Fisher would talk about using like the MSCI World or something as his benchmark. I think it's a dumb index. I think it's better if you're benchmarking and you're, say, moderate, use 60% S&P, 40%, ag bond fund index if you're benchmarking your advisor. And we found that basically clients fit into one of three profiles. One is they're kind of closet indexers, meaning they want our services and they just kind of want to get what the index gets. Those are pretty reasonable people. We can craft a portfolio aligned with, so I'm answering your question, just kind of giving you three client profiles. So they want our services. They want the tax planning. They want the income planning. They want like they want the financial quarterback and all the services we offer, tax planning, all that stuff. But basically, because we have CFPs, CFAs, CPAs, which is very rare for our firm to have, besides our firm, we have maybe, I want to say with 3 or 4 guys who have like all these CFAs, all that crap. I didn't have time to get that stuff. But one client is what I would call closet indexers. And we found that the French Fama portfolios, I don't know if you're familiar with that. No. Jun Seth, who's in the Bitcoin rooms, he always promotes that. It's basically, if you go to University of Chicago, read this stuff up. They basically said nobody can beat the indexes, no matter who you are, maybe Druckenmiller. But basically, if you look back to 1927, and we found this too, small cap value, like think VBR, although I'm not recommending anybody buy or sell that over the air. That small cap value index, if you had like 85% S&P 500 and 15% small cap value, you would outperform by something like 2 to 3% the indexes. with very little work. And we found that to be true. But then because of our clients, a lot of our clients tend to be conservative or moderate, like their risk is in their business or their risk is in Bitcoin or whatever it might be. They their target returns from us are around, let's say, like what they want us to achieve are maybe losing like half of what the S&P loses in a downturn, but making 60-70% of what the S&P makes in an upturn. And most of our clients are happy with that range because they're not all or nothing. But the French Fama theory is kind of one theory that undergirds us. Second is just individual stocks. I like individual stock picking. Even though people say it's futile, I find that from a behavioral economic standpoint, a lot of clients, if they say, dude, I'm in Walmart, Apple, even though the market's down 20%, I'm not going to sell.
Yeah.
And, we're in New Jersey Resources or PSE&G, they can raise their energy prices and the stock is still doing fairly well, though I'm not recommending you buy or sell it, and we own it for our clients. So I find that individual stocks get a lot of flack from personal finance people, like just put it on the index. Although I think if you have that index theory, French Fama is the way to go. There's a book by a guy, Edgar Wackenheim. You ever read it?
Mm-mm.
It's the best book on sort of like the Warren Buffett strategy for today. Guy, I don't know, I think he manages like billions of dollars quietly. One of those kind of guys you don't hear about. And I think all he does is manage between 20 and 30 individual stocks for his wealthiest clients, families, things like that. He's like the Wackenheim Foundation Trust. They give money to public television, all that. Sometimes you might hear the name there. And I had him on the radio show, and he just will buy like good value stocks. So we kind of like that for our middle. So do individual stocks, ETFs. And then we'll have some clients who want very little to do with risk. So we're doing treasuries. We're shopping fixed interest rates. Right now is a glory time. I can get 5 years at 4.95% right now. And we've been in these Bitcoin rooms on Clubhouse. People put 2 million in Bitcoin, then they have 800,000. They would have been better off with fixed money. And I'm not. I get this from John Malden, who says we're in it not just to diversify assets, but diversify trading strategies. So I've never seen anybody go wrong. Okay, I'm going to have 5% Bitcoin, 10% cash, 30% in, the index fund strategy, 20% in stocks, and 20% in kind of the conservative, whatever it might be, safer stuff like treasuries, fixed stuff. I've never seen anybody wake up and say, I've lost everything in that type of strategy. And most of our clients, they've come to us with some measure of success. And I was in some room on Clubhouse yesterday, and people were fighting John Ledger and Cindy Stumpo and Grant Cardone. It was like a throwback from like a year ago. I don't know what happened. I was pushed out of the room. And they were talking, what's the measure of success? Is it mindset or is it grit? Mm-hmm. Like power of positive thinking or grit. And I was on the grit side. Because I help wealthy clients every day, and most of them never want to be poor again. They don't really care about making the next million because they've, it's like where we're from. If you have a certain amount of money, you're okay and you're happy.
Yeah, it's funny because I think you get wealth creation through concentration. You get wealth preservation through diversification, right? So that's kind of the point.
That's really good. I'm going to use that.
I mean, if you think about most of the billionaires, they are all in on their companies. For the most part.
That's exactly true. Yeah, and most of the people that we've consulted, they have 90% concentration in their company stock.
That's why I sold. I didn't like the concentration risk. I had a company previous that got sued, and we had to file bankruptcy and went away. And then when the next company was, popping off and doing really well again, I had an offer to take, and I took it. Maybe if I waited, I would have got more. Nobody really knows. The world could have had a downturn right after. You just don't know what the future would have been. So I didn't like the concentration in a private company that I was managing with that kind of risk potential, having the history that I had previously. So I get why people start to diversify once they get to a certain point. It just makes sense. So what about, let's talk about now, right? It's been easy to be an investor for the last 12, 13 years. I think, it's been hard in the sense that every time there was a flicker of a potential downturn, there's a recency bias, right? The 2011, 2015, 2018, 2020, but here we are, we're finally in a real bear market. How are you advising clients now in this market? I think you might have just told us the strategy, but I'd like to hear what you're telling your clients right now, and how you're comforting them and getting them to stay in the market. I think the key is that. And then how are you protecting against the downside? Because I don't know that we've seen the worst yet. We might have, but there are some analysts out there and some economists and others and investors that are like Michael Burry, that are screaming like this could get a lot worse. I mean, a tactical nuke could be dropped in Russia, and who the hell knows where we go from there. How do you mitigate against that? And what are you telling clients right now?
I've always kind of adhered to this protection, savings, and growth model. So when I was 22, 23, I was introduced to this guy, Bob Castellone, and he had this little model, and sometimes it's been bastardized by people who use it for, whatever their purposes are. But I liked having it in a thirds, and you kind of get it from the Talmud and these various things, in a third for protection, a third for savings, and a third for growth. Doesn't mean you should have 33% in growth stocks and 33% in safe money and a 33% in insurance. But there's 27 components of wealth building. So I don't care whether you're 50 grand or 500 million or whatever, billionaire. I've seen billionaires, I've talked to billionaires, and they don't have this because they have concentration risk. Mm-hmm. And we've consulted them. Number one company we consulted said, you structure your company all wrong. They were managing of a large business development company, and they were actually extracting all their income every year was ordinary income tax. I said, you need to go to your investors and structure it and say, we got to be a growth stock because we're killing you with taxes and we're killing ourselves. They were paying like $300 to $400 million in income tax every year because their dividend was like $1 billion a year, something sick.
Double tax too.
And they wouldn't do it because they had the same accountants for 30, 40 years. And when I came in to consult, they were undermining me. But I was like, Warren Buffett does this. Why don't you have a holding company, receive but they didn't want to do it because I think a lot of that never be poor again. They figure, hey, you know what? I make a lot of money, I'm paying a lot of tax, and pick my brain. They heard, it came from me from a Bloomberg interview I did. And I still think about them, like, called them up, like, but I'm too busy. But the point is, I pretty much manage money the same I did then as I do now, in that at any time we could see 2,500 on the S&P. We could see 3,000 on the S&P. So although I'm sort of bullish, my biggest weakness in the past was I was too bearish. Mm-hmm. So I like having a pot of money for protection. So say trusts, insurance contracts yielding whatever, 4 or 5%, tax-free. Some of your money in tax advantage things like Roths, 401ks, IRAs, pensions, and then a third. It doesn't have to be a third, it could be 50% in growth, Bitcoin, stocks, ETFs, index funds. I know you do a lot of trading, because then, like, let's say you're trading 50% of your fortune aggressively for money making opportunities. The other half is kind of like not the Titanic. That's bad enough.
Let me tell you something. Friday was the Titanic. That was a tough day.
So one is like a fighter jet. You're trying to get profits. The other is, it's kind of like moving an aircraft carrier. So I almost structure most of my clients with two different portfolios. One where you're targeted to kind of beat the S&P or do similarly, and another where with less risk. I mean, and that's the key. We're not trying to, I think it's hard to beat the S&P year in, year out. So I'd rather get it where somebody gets half the risk of the S&P and maybe gets 80% of the gains. But I mean, I could structure something for high growth. It's just most of our clients don't want it, but certain amount for growth, for inflation, and a certain amount for deflation. Because you don't know what's going to happen. Everybody say inflation, inflation. We might have inflation for a year, and then next year we're at 2,500 on the S&P again, or 3,000 on the S&P, and the Fed's pushing rates to zero. So I think to have, half for inflation, half for deflation, or half fighter jet, half aircraft carrier would be good. What are we at? What are we at today? I know.
Oh God. It was down a little bit in the morning.
Yeah, I know. It was pulling up, and then
in the pre-market,
then it just crapped out again.
Let me say this. I always say, people say you can't beat the S&P, and if you just put all of your money in an ETF that's broad-based index like the S&P, and you did a couple trades, you'd beat the S&P. It's not
exactly.
that on margin. You'd beat the S&P right there.
Or the S&P. Even if you've gone back, S&P 600 outperforms S&P 500.
No, I'm just saying, if your benchmark is the S&P 500, put everything you got in SPY.
Yeah.
And on margin, you do a couple trades and you beat the S&P. It's not that complicated. Everybody says you can't beat it. It's like, actually, you can. Yeah. But is that your benchmark, right? And to your point, your clients, it is not. What you're saying sounds very similar. I had some investors in my company, angel investors, they're on Wall Street, hedge fund managers, and managing tens of billions of dollars. And I used to be like, well, how are you doing relative to the S&P? They go, that's not our benchmark. And it's exactly what you said, actually, which shocked the hell out of me. They're managing sovereign wealth money and family offices and tens of billions of dollars.
Well, if you look at Ray Dalio, he doesn't. I mean, it's basically some combo of, he would overweight the bonds for years. Jeff Gunlock, Bill Gross, they're just buying treasuries. Lacey Hunt. It depends on the goal of the client, right? I mean,
that's right. But to your point, though, it's like in the downturn, what I was told by my friends is that if the market draws down 50%, they want to draw down less than that, 40%, 30%, and they're feeling good about that. And if the market goes up 15% in a year, or 30% in a year, 20%, like we've seen in these crazy years in the last couple of years, they don't care if they get to 20%. It's like, just make sure we went up, right? Like, so if the market went up 20%, give me 16. I'm comfortable with that. Yeah. It's like, I'm not greedy, right? Because I'm more worried about the downside. And I don't think people have particularly younger friends that we have that we met on Clubhouse and stuff. I don't think they have an appreciation for how bad things can get. Yeah. They just only seen things going up in their lifetime. And it's like, if you've been through some real downturns, you understand that, like, the 2000 was difficult. That's around the time that we were just getting into the markets. And 2009 was crazy. And then ever since then, it's just been like, oh no, everything's changed. It's different this time. I don't think it's ever different. I don't think it's ever different. I think the risks are always there. And in fact, there are probably more risks because the amount of debt in the system.
Oh, I'm worried about that. It's funny. They talk about the Zennials, the people born between 77 and 83 are their own generation. And then the millennials are 84 and after. I think there's some truth to that, even with money. Like, millennials, Gen Zers, they've come of age after 09. So that money printer go burr, dumb meme, that's going to get them all wrecked. Yeah. Whereas you and I, we came of age in the 2000 to 2002 crash, which literally wiped people. People do not realize that may have wiped more people out than the 08 crash, especially where we were
the
from,
duration.
Monmouth and Ocean County. I remember guys who worked for Lucent, they had $2 million in their portfolios. I was just starting out. I said, you know what? Why don't we do something conservative? And that goes with the point of, you get a guy who goes from 2 million in Lucent stock to 50,000. That changed them. They never want to invest in indexes again. All those guys were indexers. Every one of those guys had Vanguard accounts, and they just saw them go. So
well, they were concentrated in Lucent, it sounds like.
Yeah, but besides that, they also had index funds.
Well, no, and it's true, because like the S&P, I tell a bunch of my friends, it's like from 2000, I graduated in 01. From 2000, March 2000, all the way to about 2003, all I saw was a decline. And by the way, we have a mutual friend, somebody we both know, acquaintance. I wouldn't say he's necessarily a good friend of mine, but Jason Frazee, right? So when I went to Rowan University, he was there trading. He was day trading. This guy made $3 million day trading. So in 2000, I decided my senior year, well, shit, maybe I should start day trading. He's driving a Viper to class, It's like, what do I do? And then I'm just losing money every day. And it's like, I don't understand. How did you make millions of dollars doing this? And he was like, I'm out. I'm moving to Costa Rica.
It was just a couple years early. Right? We were a couple years late. It was me. Yeah, I started.
I'm the same age as Jay too, and I just was like ignoring it. I was like, "Oh, that's silly." And then I see him driving I'm a young kid, right? I see him driving. We're in the parking lot walking to the class, and I hear vroom. It sounds like a boat, and I'm like, "What the hell is that?" And it's Jay Frazee and his Viper.
Wow. Yeah,
and I'm like, "Shit, man, I got to start day trading."
Well, I saw that, and then I did a few trades, and I got wrecked, and I was just
me too. I didn't know anything back then. And I don't think Jay did either, frankly. I mean, he understood that there was a market happening. IPOs were popping off. Stocks would pop up and start the day at $20 and end at $80. And he was just making money on IPOs left and right. I don't think that he's doing what you do in any way, but he was a young kid just in the moment at the time in the right place, and understood how to trade.
I had a friend who said, in a stiff wind, even a pig could fly or a turkey could fly. That was his saying for that type of success.
I will say one thing about Jay, not to say that he was not smart. He was very smart, opportunistic, and he flipped over to the real estate thing, moved to Costa Rica, and he's crushed it on real estate in Costa Rica because real estate's done really well. So he went from one bubble to the next bubble. Wow. He didn't get out of that. He built the surf retreat, and then he started getting into like online poker, World Series poker, and he was on TV and shit, and I saw him, and I was like, what the hell? And then one day, this is a goddamn true story, my company was an ad network, and I see all these websites signing up one day because I would get the emails when a new website would sign up, and my team would get it, but I would also get copied on it. And I saw like 30 of them in an hour. And it was like the name there was Jason Frazee, but the phone number wasn't at 609, which is your area code down there. I was like, who is this? And it says Costa Rica. I'm like, no fucking way. This got to be one of my buddies from high school messing with me, right? So I call the number and he answers the phone, and he got into online gaming and he had all these gaming websites. I'm like, this guy's he's on every trend there's ever been.
That's amazing.
He flipped websites.
Like who was like that. The problem is I was never that guy. I was never that.
No, he follows the trend. He's trend trading to win. Remember that guy? So Dalio was saying for years, cash is trash. And he just recently came out and said that cash is no longer trash. What are your thoughts on the flip there with the interest rates rising? I didn't understand his whole all weather portfolio for like 7-8 years in a row. He kept talking about all weather. I'm like, how are you buying bonds in this environment? It's a negative real return. I don't understand it. And now, I don't think we're going to expect having inflation at these rates for very long, maybe a couple of years before we get back to normalcy of some sort. Maybe it does make sense to have bonds in your portfolio. What are your thoughts?
I agree. If you can, although I think his statement's not really true, because I feel like he had cash and bonds for years. I mean, I guess he's delineating cash, money markets versus bonds, but he was advocating bonds for years, which I kind of lump in with cash. So I think he's making his PR person is probably really good and is probably manipulating that for his advantage. But yeah, I didn't understand why he had bonds when he had them. Now it makes total sense. I mean, we're seeing, you can get 1 year at 4%, 2 year at 4%. And a lot of people will be, they just don't know how to do it themselves. So we help them buy the 1 year, the 2 year, even the 10 year. So I think it's a great investment. I was looking at, there are very solid muni bond firms trading at discounts not seen since 2008. So if you can buy like New Jersey munis, for example.
Pay no tax, right?
Pay no tax, get a 5% yield, and it's trading at like a third off. Mm-hmm. We're seeing. So I think it makes sense if you manage a lot of money. And it all depends on your clients, right? Like you said, most of the guys in our business, their rate of return target is maybe different than what you would expect. So that conservatism, see, like when you're kind of describing it, people might manage for alpha, an excess return. And a lot of firms like ours, the clients don't care about alpha. They just don't want to be broke. So
that's right.
They want beta.
This is, by the way, something that the Bitcoiner community that you've met on Clubhouse, the maximalist Bitcoin community, doesn't understand. I don't think they have an appreciation for it because they don't have any money. Right? So when you've gotten rich and you come from nothing, you don't want to go back to nothing.
Yeah.
It's not about getting richer and richer and being greedy and greedy. It's about preserving the capital. And they just think, oh, that's wreck city. You're going to get wrecked. And it's like, okay, maybe, but you're wrecked already.
I would consult with Bitcoin millionaires, newly minted million. Okay, they go from 0 to 40 million. Take 2 million off the table.
Yeah.
Take 5 million off the table. I am probably more of a Bitcoin maxi than they are. Even that, like, I'm not as tech savvy as some of these people. I get Bitcoin. It makes sense for me as the digital gold. I don't believe in all these other, altcoins, shit coins, cryptocurrencies. They may have utility and they have value. I don't even understand it. That's not my world. So I spent the time in Bitcoin. I get it. And I just think too, it's like a closed loop. If there are enough Bitcoiners to create their own economy in the future, let's say there's 10 million Bitcoiners, well, we'll just transact in and amongst ourselves. Mm-hmm. Whereas every other current cryptocurrency kind of fades to the background, and they'll just be like a Bitcoin bartering system. So it always made sense to me from that perspective that there's only one Apple, right? There's only one. I mean, I guess chips are different, but Intel still has 90% of what? I mean, the chip business. AMD's breaking in, Apple's breaking in, Samsung's breaking in now. But that was my analogy before. And there might be, the Ethereums that come in and creep up. But I don't get that. I don't really understand it, so I avoid it. And I've had people too come to me. They make $4 million selling their small business, right? Just saw a couple last week. They lost $500,000 in some altcoin scam. And if you took that $500,000 and just bought S&P 600,
and they let it sit,
they'd have $5 million in like 20 years, and they've lost that forever.
Yeah.
So to me, I got into Bitcoin just to make sure my clients didn't lose money. So I want to learn about it. Studied, and then I became a believer. But yeah, I think a lot of, people that shall remain nameless, they lose a lot of money because they don't understand asset allocation. Asset allocation doesn't mean you'll be rich. It means you'll never be poor, typically. And the Dalio,
like I said earlier, it's about wealth preservation versus wealth creation.
Yeah.
So concentration is creation and preservation is diversification.
We'll put it on.
I don't think I came up with that. So let's do the market call of the day. When does this bear market end and how?
Okay, I'm going to give you two scenarios, not to cop out, but because we literally have two scenarios that are firm that we're playing out. I am very worried about us breaching the low of September. I'd give you a number, 3550 on the S&P. If we break that, I think we're very easily going to hit 3450 and then probably easily hit 3200, 3300, kind of bottom out in December.
Okay.
I also see another scenario where,
by the way, Josh, what could be a catalyst to breaking down?
Democrats win the Senate. If you look at Warnock potentially beating, think about I'm more conservative, but the Republicans pick literally some of the dumbest candidates. They should win Arizona. They should win Georgia, right? But they pick a guy who, now, if I was in Georgia, I'd probably vote Herschel Walker over because I like Herschel Walker. You don't think negatively when you think of Herschel Walker. But I don't think it was a wise choice for a state that elects Marjorie Taylor Greene. I think there will be so many people that won't vote. I think Georgia should have been an easy win. I don't know who's recruiting people in Georgia. Last time they picked that woman who sold stock ahead of the COVID crash, Kelly Loeffler, remember that? So I could see the Dems winning in November, causing the market. If that happens, I think you're at S&P 3000 by December. Or some type of nuke in Russia. But I also see, and we follow time and price series forecasting too, and trend following and charting, see another thing where kind of the buy Rosh, sell Rosh Hashanah, buy Yom Kippur trade. And I could see maybe a few weeks ago that 35.50 was the low. And we have this bottoming process from now to December, and then zoom in 2023. I'm very bullish on 2023. Where I'm very bearish is 2024, 2025. Like, I think we
Really?
are on the verge. I think we're going to have this massive relief rally maybe over the next 6 to 8 months after December. I am worried, and Clubhouse is an indicator. I've met so many people, I'm sure you've met, who are now real estate millionaires. They bought apartment complexes with zero to little down. In 5 years, got to realize the Bitcoin noobs or the real estate millionaire noobs, what did they do? They bought 5-year interest-only mortgages, thinking rates would be low forever. So 5 years refinance in 2020 points us at 2025. So maybe 2027, I think that will be the crash of a lifetime.
So you think this is very similar than the 2004, 5, 6, 7, where people were doing the arms and then they all started, the readjustment came in as the interest rates went up, and then
But this is major because it's multifamily. I don't know how many people I know.
How do you have any data on like how much was taken out? How many loans
I want us to get data. It's just a thought. Yeah. It's like
it's a thought experiment. Okay.
It's if you can get data, let me know, because I'd love to short that because I don't even know how do you short. It's basically guys like
call Michael Burry.
It's guys like us who we're more conservative, who said, you know what, you're never going to lose money in real estate.
Yeah.
So I'm going to buy a $10 or $40 million apartment complex in Florida.
It may not be a systemic issue, to your point, though. It could just be a lot of people get wiped out.
I've talked to a lot of people because the big money sold the last 3 years.
Okay.
And if you talk to even Kiyosaki, who, you know, is more known, I guess, for his education business and his real estate, talks about, hey, I was getting rid of all my real estate. Well, who's he selling to? So I'm worried about that. But so bullish could be a week ago. But I think if we break 35.50, 3,500, I mean, if you notice, even today, we're holding at 36.09. Is that forming a bottom? I think the next 3-4 weeks are going to be volatile. 3 reasons the market could zoom up. Russia-Ukraine war ends. That would cause the market to rally 10% very easily. Republicans win. Markets love gridlock. And then the third thing is CPI numbers start coming down, which David Ranson and some of the other people who were one of the only people of economists to say we'd have higher rates, higher inflation. I know you were one of them, so I'll give you those props. But very few people were in the inflation camp. Everybody was like deflation forever. Mm-hmm. The negative story is, you know, you get a nuke, you get, I think, just downward technical.
Well, I was going to have that on my list of things to ask you about. Like, what do you think the likelihood is that Putin, because his rhetoric is kind of amping up. I forget if it was maybe it was Paul Tudor Jones I saw this morning, and he had an interesting comment, which is anytime you've seen a world leader dictator like this get backed in a corner, it ends badly for them. Violent death, right? Who's he going to take down with him is what he said. That's the concern. And so the potential is maybe it's just regional. Maybe it's a tactical nuke potentially in the Ukraine, which like an onslaught of response would have to happen and try to take them out. Maybe it's worse. Maybe it's Europe. Maybe it's America. Maybe it's something really bad. And nobody can really know what's going to happen. But how do you protect against that? Are you buying puts for that? Like, what do you do for that in the market?
We buy treasuries. Treasuries. I mean,
but your equities could get decimated, right? If something like that happens, we're seeing S&P drop to lows that we haven't.
Well, yeah. Well, you have. Okay, you have. I'll be very conservative. You have fixed annuities paying 4.95 for 5 years. You have fixed annuities where zero fee. Where they're buying long call options. I mean, this is if you don't know how to trade on your own. You know what I mean? If you don't know how to trade on your own, you could do puts. You could do any number of things. But there are insurance contracts right now, zero fee, where if the S&P goes up 10, 11 for the year, you get 10 or 11 because they're buying long call options. And if the market does go to 2,500 or 3,000, your options expire worthless and you get your money back, your principal. So indexing was big in '08. I think indexing is going to be big. Not indexing like ETF, S&P. I mean like indexing where an insurance company will manage your money in a basket of treasuries. But I mean, people could do that on themselves. You buy treasuries at and then you take the yield off of those treasuries. So if you think about this, if you have somebody with a portfolio and they're really worried about that, if you have whatever, let's say it's $1 million, $1 million at 4.95% interest over 5 years means you're generating 49 grand, right? Couldn't you take that 49 grand? You could buy puts and or you could buy long call options. So if the market goes to hell, you get your million back. So you can do it without, doing it through an
And then
insurance
you're hedge
company.
neutral essentially.
But just, that's sort of what I'm seeing. I would like to have some big short trade, but
to win.
That's not what I do. Maybe we can come up with something. Our clients are just not that, they're too risk averse for that.
Last question on Bitcoin. You've mentioned a bunch, but I was curious with your clients, when they say I'm interested in Bitcoin, or you tell them that they should be interested in Bitcoin, what percentage allocation of their net worth are you suggesting that they have? And by the way, do you suggest and advise that, like, let's say we go from 20,000 to 200,000 over the next cycle, would you say rebalance that?
I'm not a big believer in the rebalancing of your Bitcoin stack.
I agree.
Unless you're so over concentrated right now. To me, it's like you'd said one time, hey, you bought a bunch of SPY in March of '09. There's certain, I have an index-based thing. I put, $1 million into it. I'll never sell it ever.
Yeah. Once you get past a couple cycles, there's no reason to ever.
That's kind of how I view the Bitcoin stack. If you have 100,000 allocated to Bitcoin and it grows to $1 million, just keep it forever. Because to me, it's a forever kind of asset. Maybe you'll need it, to transact down the line. I think, get off of zero. So for people on zero, maybe 1%. Somebody's on 1, maybe 2. Somebody on 2, maybe 5. I like personally, 5 to 10.
But if it grows to, like, to your point, if it grows in 5 or 10 years to 99% of your net worth, maybe take a little bit off the table, I guess you would say, to your clients, but leave the majority of it because it's a hedge against the debasement.
Yeah, you also got to realize a lot of our clients will have $1 million to $5 million in cash right now, or very conservative stuff. So I don't mind having certain concentrated assets in other buckets, because a lot of our clients come to us and their concentrated risk is their business. So we're kind of working around that risk. And it's the same with Bitcoin. If Bitcoin blossoms and hits 100,000, which I do believe it will eventually hit, it's just a matter of when. I think, unless we have some renaissance where, what's his name, DeSantis or somebody wins in 2024 and they balance the budget, that's the theory. The future is always different than people envision it. And the story from Bitcoiners that I think was wrong was they would make a bullish case for Bitcoin because money printer go burr, rates will stay low forever. So Bitcoin is the central bank hedge. It may be, but it's also a good technology. It's digital gold. It has utility. And to me, I think Bitcoin has value at 3,000 as much as 30,000. So to me, it should be a certain amount in your stack and just let it grow.
Druckenmiller, I sent this to Joe Carlos Arley on Saturday, and then yesterday he tweeted it out. Didn't give me any credit. Joe, what's up, man? Druckenmiller said NASDAQ type risk players. Sorry, let me read that again. I said it incorrectly. There's feedback in my earbuds. NASDAQ type risk play takers are the ones that tend to play in Bitcoin. And the gold bugs are the ones that play in gold. And so do you think that that's right? And why do you think that is?
Wait, who are the ones that play in gold? Or as opposed to the ones who play in gold?
Curmudgeons who are gold bugs essentially are the ones that want the world to fall apart, and they're the ones that are in gold. So the NASDAQ type risk play players are the Bitcoiners. And so what he was saying is not inflationary, in a bull market, he likes Bitcoin. In a bear market, he likes gold. Although he still owns Bitcoin, but he was just saying like he thinks that it performs better in a bull market than it will in a bear market.
I think there's some truth to that now, but if you notice, Bitcoin it used to trade with the NASDAQ. Now I think it trades with the S&P. What does that also tell you about Druckenmiller? I think he's trading against. I would love this data too. I think that tells you a window into his investment philosophy. I think he has people hanging out in the clubhouse rooms or in online trading against NASDAQ flows on SQQQ, trading against the pro Qs. I think he's right. I don't think it's everybody, because I think the Bitcoin community is half and half. I think half of it's former gold bugs and half of it's NASDAQ people. Maybe I'm wrong, but
I think the ones we hear from are the loudest voices are the maximalists.
Yeah.
But I think there's obviously, just by the numbers, there's like a couple 100 million people that own Bitcoin. Most of the people we don't hear from, and we don't understand what their investment thesis is. But the ones that are the voices, the Preston Pitches of the world and all the others, American Hodl, et cetera, they have a collective group think, I think. And I don't think that that's what Bitcoin as overall is thinking. I think most people are just, they're probably trading it or something. You can just see the volatility of it. It's just being traded a lot, the hedge funds and stuff.
Yeah, I think they're trading against the collective Bitcoin zeitgeist, or whatever you would say. But I got to Bitcoin different, more from the gold diversification play. Like, if we're in a world maybe kind of dystopian, but COVID got me really into it. I mean, I'm late to the party. I kind of came in when Scaramucci came in, but I saw it as, dude, our government can shut things down. And COVID reaffirmed the value of Bitcoin to me. What if we have to flee the country? What if, so to me, the transportable nature of Bitcoin, and that it can transfer across borders, and it gave one individual sovereignty, sort of the gold bug, not really a gold bug. I mean, I have a lot of emergency food supply, but I don't.
The thing, Tone Vase, if you know who that is, he talks about this quite a bit because he comes, I think, from Russia, and he talks about it as unconfiscatable. I think he has the conference, and I think that's like fear mongering when people do that about Bitcoin. Not that I'm saying you are, but the people that do that.
No, but that was the reason I got into it. I just thought, because if it's a growth thesis, right, you could buy the Qs.
Well, you won't outperform Bitcoin if you do that. So from that perspective, Bitcoin will outperform the Qs, right? Here's what I'm saying, though. If you believe that the government will try to take your money, like Bitcoin Tina, bail-ins and all this stuff, right? Bitcoin is definitely a hedge against that, but you'll see that coming. You're not going to wake up on a Tuesday during good times, during the bull market like 2021 and be like, oh my God, all of a sudden they just took all our money. Like, that's not going to do that. You'll see it coming, and that's when you need to start allocating, right? So if that's the thesis, it's a bad thesis to try to get people to adopt Bitcoin and understand Bitcoin, because in times they're good times, I'm not worried about that. Why would they just wake up one day and decide to just,
I don't know. I think they will wake up one day and do something crazy. I mean, I remember I woke up during COVID, went to the local
That's during
bank,
COVID bad times, not during good times.
and they were limiting withdrawals. And I was like, dude, this is the biggest Bitcoin bullish thesis for me. Not that I'm not of the Bitcoin Tina philosophy completely. He's not even of his philosophy. He's so
exactly
his Bitcoin. But
that's
me,
the line of the day.
if one has 5% and I like Tina, but I do.
Listen, I ride Tina quite a bit because he came out to be very hypocritical. I would have had a lot more respect if he was like Michael Shapiro on Clubhouse, which is just stick to the thesis, even if you don't still believe in it, because at least you're consistent.
No,
right?
I appreciate that he was honest about
I get it.
His own state where he lowered his exposure to 90% to 10%, which is probably what I would have said was appropriate for his net worth anyway. But so I appreciate when someone says, hey, I screwed up.
He's going with the old thesis on Wall Street. When you have new information, you have a right to change your mind, and that's true. It's just the way he approached it last year when I was doing what you were just saying, Josh, was
You
like,
were
I
in the
think you're
minority.
overallocated for your age, and he's telling me I'm an idiot and all this, and you don't understand, and you're a fiat minded person who made money. All your private equity's going to zero. They're going to bail you in, and I'm like, this guy's a fucking lunatic, And then he just completely flips when the market crashes. I'm like, come on, dude. I told you this last year.
Well, I like him, but a lot of people are emotional investors.
Yeah, he's definitely
And
an emotional investor.
I think it's a great lesson for me because I was telling people December, November, I'd go into our Bitcoin rooms and I'd say, have 1 to 3 years of cash in the bank. And people are like, who the heck is this guy? Financial nickelbacker, instead of the financial quarterback, you're going to be broke. You're going to be living in a van down by the river. And if he had done that in November when I was preaching that, he would have been way better off.
Could have bought a lot
And
more
the,
Bitcoin today.
and the reason I get that is I actually get that from long-term S&P 500 types. If you go back, I have this kind of we go to the annals of history. If you went to the Great Depression, right, and you had all your money in the S&P equivalent at the time, and you had 1 to 3, and you had 3 years of cash, you would have weathered the Great Depression and never had to sell. So that's kind of where I got that. So if you're a purist in Bitcoin, and I'm a Bitcoin purist or Bitcoin maxi in the sense that I believe it's the maximal cryptocurrency, and I believe it will be the one kind of
Jason
ring.
Williams, just your point on this, he calls himself a Bitcoin money maximalist.
Yeah.
Not that he won't do other things. I don't
Yeah.
do other things, but he does other things and like rare pepes and all this other stuff. But he's like, I'm not doing that because I believe that this is a sound money. This is just a trade. So he'll trade just like you would
So
trade
I'm
a
a
stock.
Bitcoin money maximalist. That's a good phrase. I don't really get. Yeah, I lost my train of thought.
I have tendency to do that. I'll get it in the comments now. Why are you cutting the guest off?
What did I say? What was I saying? It was good. It was going to be a good point.
That you're a Bitcoin, basically like Jason, you're a Bitcoin money maximalist. You believe that out of all the cryptocurrencies, it's the one, Bitcoin is the one thing to own, not the others.
Yeah. But the 1 to 3 years, I don't know. I don't think you'll get screwed if you'll do 1 to 3. Oh, okay. Here was the thing. If you're a Bitcoin maximalist or a Bitcoin money maximalist, if you have 1 to 3 years in treasuries or cash, I think in 3 years, Bitcoin will recover. So if it recovers,
cash gives you the ability to
3
recover.
years, it gives you the ability to pay the mortgage. I mean, also, by the way, everybody has a wife or a significant other or husband, whatever it is. If you're the Bitcoin maximalist in your family, I don't know about you, but like my wife doesn't care about Bitcoin. She cares about, ordering, Whole Foods online for the kids so they have organic food. And if that money's not there, then she'd have a problem. She's pretty simple. She's not, buying Gucci handbags or things like that. But if the money's not there for the kids' groceries, she'd have a problem. And so that's where you need, 3 years of mailbox money that's coming in every month to meet recurring expenses. I think whether you're into trading, if you're buying the triple Qs or if you're buying Bitcoin. But that was an interesting thing about the Qs and Bitcoin. I think that's true to a lot of people, but I think it's more true to the people that we talk to. I think that like the average client that I know that might have 1 Bitcoin or 2, they're buying it like just in case that thesis is the kind of bail-in thesis is correct.
Yeah, that's probably right. And if Tina's listening to this, I'm not trying to ride him. I was riding him on Twitter because I do like Tina. I mean, we've had private phone calls and stuff. He's a nice guy. But my thing is, if you're going to be a voice out there like you are with your show and going on social media and stuff, you just got to be responsible. People are listening to the shit you say, So I think that you've been pretty responsible.
I feel bad for the people who maybe listened to the advice. And it wasn't just Tina. It was everybody in the bull craze. Bitcoin's going to 100,000.
Yeah.
We all got it. The Pump It Up song. I just want to, You know what? I think we should just start playing the Pump It Up song anyway, because it was fun. Everybody was getting excited. And, now everybody's doesn't play it anymore. But
Now everybody knows what a bull run feels like, a real bull run. So when we go through this crash and we come back out at the end of the next bull run, this is exactly how it will be. you'll be older at that point. You'll be like 50 something, and you're like, okay, let's kind of take some risk off.
and then you start shorting. It's funny though, however many times I've been through what, 2 or 3 bull runs, I've always had the courage to go to cash and to be ultra conservative.
Yeah, me too.
Had not shorted, even though it was so clear last year, had not shorted the way that I should have.
I didn't short at all. The one thing is, you heard me calling it exactly as it played out, and I didn't play it. Everyone's like, "So what are you doing to play this?" I'm like, "I'm not, because I can't put my money on that. I'm just telling you, it's pretty obvious with elevated PEs, et cetera, all the different things, GDP, et cetera. I mean, everything was off the charts. I was like, something isn't right. Inflation's on the way. Like, it was just obvious, but nothing's a guarantee. So I wasn't trying to play the bet.
I know, but that's my point. Even we should have put like 50 or 100 grand.
I know.
It's just like we didn't.
Next time.
And I was there. I think it was just more trying to be responsible. And because I have the aircraft carrier kind of, the protection savings growth, I always have a certain amount for protection.
Yeah, I wasn't worried about like if it crashes, I wasn't all in, right? Like I have a lot of cash. I always have a lot of cash, to your point. And by the way, I think one of the things that do a really terrible job on CNBC and all the different TV shows, and I think even all the newsletters and everything, is like they're always talking to the investor that's just going in the market. What about, there's a variety of different types of investors. You have wealthy clients that have family-run businesses, or they still operate a business. You also have clients that have sold a business and they have nothing right now. They have no income. They have nothing. That's a different client than the one that's currently running a business. And then there's the person on the way up. He's an executive at a company or whatever they might be, and they're still earning and they're growing their net worth. And each of those types, and there's a lot of other types of profiles, but those 3 types of personas should probably have different investment goals and strategies.
Yeah, I mean, to me, it's about income generation. We have a client, we take them through, and if they have, I was talking to a guy on my radio show this weekend. I said, "What do you need to live?" He said, $5,500 a month. Like, live comfortably. Wow. Single guy. Not. Yeah. I wish. Yeah. Right? He says $5,500 a month. I go, "How much is your Social Security and pension?" He goes, $7,000 a month. I go, "Well, then you really have nothing to worry about. You could have all that money in the market, be okay. But if you need $12,000 a month to live and you're making $7,000, you have an income gap of $5,000. So income gap planning, which is something we do, is really never talked about on CNBC. It's one of the seminars I do that if you listen to it, you'd be like, duh. But very few people even talk like that. It's just you do a simple calculation of what someone needs in income. And that's the same thing with Bitcoin, right? If you need monthly money to live, you probably shouldn't have that in Bitcoin.
There was no way to generate income for the last 7-8 years. When you looked at it, like you had to buy stocks maybe for dividends, but like bonds didn't pay anything. So we sold our company in 2015. I was like, there's no bond strategy actually. That didn't even exist.
Well, we had it. We had it actually.
Well, you could do municipal bonds and things like that. I just didn't like the risk profile on it. We did do some municipal bonds for a little while, but I just didn't like the risk profile because I was always afraid that in a downturn that could go insolvent. The treasuries, that is the risk-free, right? They're just going to print more money, give it to you. So
you could do munis, you could do treasuries, you could do annuities. We're yielding like 5, 6.
You do carry risk with an annuity because the company has to be solvent to pay it, right?
Yeah, well, you just spread it out. I mean, what Mass Mutual, all those, you just pick an A+ rated.
What are they paying right now, the annuities?
Depends on what type. Fixed, they're paying about 4.95 for 5 years. The income for life ones, depending on your age, pay like 6, 7%. You could bail out it after 10 years.
Why would people buy that versus the treasuries, which are not that far off right now?
Because if you get 4 on a treasury, you could probably get 7 on a yield on an annuity, and that 7 lasts for life. So if you're 6, I mean, we're a different age group, but if you're 60 or 65 and you need the money to last you 20, 25 years, and you can pop 2 million in something, you get 120 grand a year for life, plus Social Security, you're pretty good. And then you take the rest and you risk it. And then a lot of them now, the old knock on annuities used to be the fees. You can get now like Vanguard type annuities for 0%. Vanguard doesn't do them, but other highly rated companies do them, and they have zero internal fees. So you just pay, basically, if you bail on them, there'd be a surrender charge that lasts maybe 5 to 10 years, which is essentially ensuring that if an insurance company's buying, basically they're buying bond, like Scott Minerd of Guggenheim, he makes his money buying bonds for insurance companies, security benefit, all this. So it's really just like buying a very high grade quality bond portfolio. But the average financial advisor, this is a great financial tip. Your financial advisor doesn't know how to manage bonds. Bond trading is a very, seems easy, but there's a reason why some of the best bond traders in the world are billionaires. It is far better to have the insurance company pick the bond manager than you in most cases. Mm-hmm. And the only risk then is a surrender charge where you don't like what they're doing. You just want to walk and you lose maybe 8%, which that's way better than what people lost on TLT this year, way better than what people lost on LQD. And I'm not like a shill for annuity. I'm just saying, people talk about the 60-40 portfolio. Mm-hmm. And I appreciate Tina actually mentioned this since we talked about Tina. He's getting a lot of free airtime today.
Yeah, exactly.
He was
got to monetize this.
He was talking about the 60-40 portfolio being dead. I talked about that years ago in my book, Retirement Reality Check, which is available on Amazon. And my point was, even if you're an indexer, have annuities and things replace bond funds. Because to me, bond funds make no sense right now. Other than as a trade, if you're trying to like buy calls or puts on them,
Josh, thanks for coming on. I enjoyed this. I think I want to have you on more often for shorter episodes. This one, I wanted to go over your background a little bit too.
Sure.
To talk about maybe market conditions. I think it's really fun. And you're right here. So it's great. You're right, Tom Observer. Tell everybody where they can find you.
You can find me, get my book, Retirement Reality Check, retirementrealitycheck.com, or find me on Facebook as The Financial Quarterback, or Twitter, YouTube, and TikTok. Surprisingly, my TikTok is growing. So
I love TikTok for financial stuff, like the little short. So do you have a team internally that does the social stuff? Do you have somebody working on it?
I'm building it. If you know somebody, your stuff would do really good on TikTok too. Yeah, I had like three videos, 2 or 3 go semi-viral. I mean, I'm just like jerking around now, but I might allocate more time to it.
Have you ever met Gary Vaynerchuk? Did you ever meet him?
Yes.
I think
my producer actually on my radio show worked for him for a number of years.
That's right. You did tell me.
And my website, so people find me, Jalinski.com, or they can reach out to the office, 888-988-JOSH. Isn't that cool? I got 988
That
Josh.
is pretty cool.
I also got, since we're from Tom's River, 240 cash. I don't, it's like maybe I could sell that to one of those cash for gold.
I can't believe you got Jalinski.com. There's more than one Jalinski in the world.
No,
how'd you get that?
I don't think. Yeah. There's not, it's funny. When I first heard about you, Jay Gould, I thought, I looked up Jay Gould and then I saw the old robber baron. That's got to be cool.
I started a website years ago, and Reid Hoffman invested in it, and a bunch of kind of notable guys. And the concept was called WikiU, and it was that there should be a biography for every person on Earth in a world where we're recording everything digitally now. There's like, think about it, when you die, a couple hundred years from now, you'll be forgotten, right? Particularly like your mom. We're a little bit more notable, so maybe there'll be something on the internet or something. But if you have so and the concept was derived off of my mom, who has a different last name. She remarried. She got divorced, remarried. When she looks up Jay Gould, she sees the railroad baron. And I'm like, I don't think my mom is looking for the railroad baron. I think you got that one wrong, Google. So I tried fixing people search and I failed miserably, but it's a good idea. Hopefully somebody will figure that out someday. But yeah,
I think it's a great idea because it's funny. I you mentioned even before my father, I put him on my website. He didn't really help me start my company. I mean, he came in and filed for me, shredded papers, gave him a job in his retirement. But my dad didn't really help me start my company, but I wanted to give him a tribute on my website so that his memory would kind of last forever.
Mm-hmm.
So that's a great idea.
Yeah, I think, at least for me, legacy is always something I think about. I think you start thinking about that when you've made a lot of money, and you start thinking, how will I be remembered by my kids or my grandkids someday or something like that? And you start projecting out. And I think most people are just running on a hamster wheel. They're just worried about next week's paycheck and putting food on the table and clothes on their kids' backs. And which is sad because they can't think about what they really want to do in life. Unfortunately, they're forced into working for a living and trading hours for dollars, which sucks, which is why I do this show. And, kind of keep myself out there in the public eye a little bit. And I think everybody who's done well should do that, to try to help encourage other people to try to strive for more financially, because it takes a lot of stress off of you. The number one reason why people divorce is over money, unfortunately. It's pretty sad. So yeah, no, I think about legacy quite a bit. Probably more than the average bear, maybe more than I should.
No, legacy's everything. I remember we're talking to Hoddle, and Hoddle's like, I don't care, I'm dead. My dad did a trust for me, and he's lording over my life or something like that. And I said, but you've spent your whole life, 30 years building this or 20 years building this, and your whole life's talking about Bitcoin, your wealth. The only way to transmit your values is through, this could be a whole future show, is through legacy planning.
Yeah.
But we've been taught from the financial planning industry, it's really about a product, life insurance, or a trust by an attorney. But it's really much more than that. It's values planning. We help a lot of elite families, craft family retreats, family values systems. I have so
It's
many
like Garrett
clients.
Gunderson talks about that in his book, actually.
Yeah. Garrett and I were part of the same study group. We were both rookies of the year in our particular financial firms. He was in Utah. I was in Pennsylvania at the time. And we were mentored by the same guy. So Garrett actually got that from our mentor, guy from Jersey, by the way. And Garrett does a lot of good work. But it's how do you transmit your values? Family wealth retreats. And many people don't do that. Like even for me, for my wealth, we're doing various things. I don't want my kids to have so much money that they'll not have an incentive to work. But I want them to be able to have freedom for health, education.
See, this is funny. I'm about to hop, and now we're in a whole other discussion. But I disagree with this. So I want my kids to have so much money that they don't have to work, and they can focus on the things. Because I don't think that humans were like, think about this. Money is a concept that we've created. We were not put on this planet to go work, right? We were put on this planet to survive. And I believe the meaning of life is happiness. And I don't think you're happy by working for somebody else, fulfilling their dreams. That's just my opinion. And I'd rather have created a lot of wealth, and then they can manage the investments and do whatever the fuck they want.
Well, it's the same way. I'm saying the same thing, but differently.
Mm-hmm.
What I mean is I don't want them to be a loaf.
Yeah.
It's not, I want them enough money for their basic needs where they can then pursue their dreams. So, I mean, there's similarity to that.
I also have this thesis that I'm going to botch this in some way, but I just think that we're all slaves. Even the wealthy people are slaves, in a way, just in a different way, at a different level. No, and so, all we've been doing in humanity is trying to get out of slavery, right? And different forms of slavery. And some of them are very brutal, obviously, like American slavery with African Americans and stuff. That's just different. But there's a modern day slavery, which is the economic system. And so how do we escape the slavery? And so that's kind of like my intended goal for my family, is to try to be able to do that perpetually. That's why when people are like, I'm joining the Billionaire Pledge and giving all my money away, I'm like, why the fuck are you doing that? Of course, there's tax benefits, about, right? But yeah, so to me, it's all about like trying to get my family out of this repetitive cycle of, I mean, you think about this, right? You're a wealthy individual, and you're probably the wealthiest person your family's ever had in the downline, right? Would you go all the way up the line?
Yeah, that I'm aware of. Yeah.
That you're aware of, right? It could have been reset because that happens, but probably not.
We go back. There was somebody who was like a tobacco farmer who might have had a lot of land, but
not my family.
But this was like 200
people
years
think
ago.
I'm a part of the Jay Gould dynasty, and I'm not.
Yeah.
Not in any way.
I'm a distant relative of Winston Churchill.
Interesting. Okay.
But we didn't, get any money from that. But it was.
Yeah, but my point is that, like, you go through this, you finally break out of that trap. You don't want the family to go back to it because it could take hundreds of years, if maybe never getting there again, So that's
True.
kind of what I try to preserve.
No,
anyway, Josh, thanks for coming on. I appreciate you coming on today. We should definitely do this again.
Awesome. Thank you, bud.